Handful of tech names really driving the market's momentum since the start of the year. You've got big tech names like Nvidia, Google, and Amazon leading the way. But is the market's growing concentration, is that posing a risk here to the broader market? And is it still the best bet for your portfolio when it comes to big tech? So we want to bring in Dan Suzuki. He is Richard Bernstein's Deputy Chief Investment Officer. Dan, it's great to talk to you. So I guess just share with the audience here, how should we be viewing this concentration that we have seen among leaders within the market? Is there still reason to be betting on some of these larger tech names, or is the real opportunity elsewhere?
Well, Madison, it's great to be on your show. Thanks very much. I'm very excited. Yeah, I think we have a very core philosophy at RBA, which is that returns are greatest when capital is scarce. And if you think about the flip side of that, that may be more relevant right now, which is that risks are greatest where capital is crowded and concentrated. And I think that's very much the case today. In fact, you could argue that on a global basis, within the equity markets, concentration has never been greater than it is today. So, whether you're invested in the S&P 500, the Russell 1000, the Wilshire, 5000, or the ACWI Global Stock Market Index, it doesn't really matter, because if you're just your average investor out there, your portfolios tend to be dominated by a handful of stocks. And from a prudent diversification standpoint, there's a lot of embedded risks in there, especially when you consider that's the most expensive area of concentration as well.
Dan, as you know, I think the market is more than happy to look past the critical little details like how expensive a stock is, as long as the market continues to go up. Why should investors be worried about something like valuations when we are still seeing so much growth ahead, even for the biggest gainer like an Nvidia moving forward? Why does the valuation matter?
Yeah, I mean, you make a really good point, Madison. In fact, if you look historically, valuation is a terrible timing indicator. It basically tells you zero about what's going to happen to any given stock or the overall market on a 1, 2, even like a 3-year time horizon. Tells you very little. But it does tell you where the risks are. And when you combine those risks with the fact that, for the big cap tech companies, their earnings growth is actually decelerating. So if you look at the levels of their growth, they're very strong and they're very, much higher than the overall market. But those levels are actually starting to come down. Even in the case of any of those mega caps you mentioned, with those slowing earnings growth, I think what's critical is the rest of the market is actually seeing the opposite, in that earnings growth is going to be accelerating from here. So the acceleration that analysts are forecasting at the S&P level over the next 1, 2, 3, 4 quarters is not going to be driven by those mega cap names. It's going to be driven by the rest of the market. And I think that's actually quite exciting.
Dan, are you at all worried about what we're going to be hearing from the Fed over the next couple of meetings, or what you're talking about when it comes to earnings, when it comes to that investment growth that has really been the focus of the conversation so far? Is that going to really outweigh any sort of hiccups that we could hear from the bank?
I mean, I think there's a potential risk embedded in there. I personally think people overemphasize, the importance of the Fed, especially where we are today. I think, we have to remember that the Fed is a lagging indicator whose whole process is built around, targeting and managing to lagging indicators. If you look at unemployment, you look at inflation, those are official lagging indicators. So if you want to know what the Fed is going to do here, I think you really have to focus more on growth. And so it's really the growth angle that's going to be the driver of the Fed's actions here. And I think unless you see growth surprise meaningfully to the upside or meaningfully to the downside, the Fed's probably going to be, not really a huge factor for the overall markets. I think people should be more focused on what earnings growth is going to do. And again, that's where we're actually quite optimistic, because nothing we see in the data suggests that earnings growth is peaking out or rolling over. In fact, we think it could be accelerating further from here.
So you note that earnings growth is broadening. I'm curious about the degree to which some of the consumer weakness that we have been seeing showing up in earnings could be a headwind for consumer names in particular moving forward. I think about a McDonald's, a Starbucks. If we do start to see consumer weakness weighing on earnings, is that potentially a risk to that earnings growth?
I don't think so. I mean, my base case is that the consumer is probably going to continue to be, one of the weaker parts of the overall economy. Now, that's the opposite of what we've seen before. So the pendulum's kind of swinging the other way. I mean, this time last year, we were in, if you think about the manufacturing goods side of the economy, that side of the economy was basically in a recession. And so that side of the economy is recovering. That's the bigger driver of corporate profits, and that's what's supporting, that acceleration that we're seeing. But the flip side is, that services and consumption side that's been very strong is starting to gradually slow from here. I don't think it's going to fall off a cliff, and I think the jobs report that we got last week kind of solidified that things are normalizing lower. They're kind of gradually slowing, but they're not falling off a cliff. But I do think that later in the economic cycle, as inflation, remains tight, the consumer has a lot more exposure to that part of the economy, and that part. And so I think those, are probably the areas you probably want to have a little bit less exposure to, where we are in the cycle.
All right, Dan, really great points. Thank you so much for joining us. We really appreciate it. That was Dan Suzuki. He is Richard Bernstein's Deputy Chief Investment Officer.